also there, whenever evaluating depreciation, there requires a method of apportioning the cost over the useful life. And some of these methods include straight line depreciation method, which allocates the same amount of costs for each year. And then there's the sum of digits years. And here's the formula for straight line. And sum of digits, as you can see, it's weighted up top, and also similar is the double declining, and it's also it'll be a weighted value. And here's a table displaying some of the values. Straight line in this case would be 2. I think this was in millions of dollars or something. But the sum of years digits will give a higher value for the first years of the useful life, and so does the double declining balance. Typically, the IRS respects the straight line and the double declining balance methods these days. Sum of years digits has been used, but is generally not used anymore. Nowadays, what is typically used now is the MACRS method, which is I don't think I have it. Modified Accelerated Cost Recovery System. And this system that they use now, it begins with the double declining balance, and then once, say halfway through the life or so, once the straight line balance generates a higher cost for that year, it switches over to that. And the reason doing so is the more depreciation is in a given year, the less taxes paid. And it is better to pay less in taxes in the beginning of the project life than at the end. And this is because, as was spoken earlier, money now is worth more than money in the future due to inflation. And taxation has a direct impact on profit. And today, the federal tax rate is approximately 35% for most businesses. And with the accumulation of state and city and local taxes, this usually sums up to about 40 to 50% of earnings. And companies generally have attorneys and accountants to ensure compliance and to maximize the benefits from taxes. And here is a table with just a few of the general formulas for expenses, income tax, after-tax net profit, and after-tax cash flow. And these involve expenses are manufacturing costs plus the depreciation. Income tax is revenue minus expenses times the tax rate, and the other two I'm not generally sure of. But that is it for our presentation. Any questions?